Jane writes in on Facebook, hi, I'm a huge fan and a student of Mr. Buffett. Please ask him what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good, and does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter, but generally speaking, with but there are a lot of other variables too, but the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe, or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think of it, the 10-year at 1.4%, that means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now, if somebody came to you with a stock and said, you know, this is a terrific stock. It sells at 70 times earnings. The earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rate. It never crossed their mind. With supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. We've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.